Assalamu alaikum friends. In this video we shall see an overview of the accounting for value added tax, which becomes a current liability for the person who is selling goods. So from the seller's perspective it is a current liability, although from the buyer's perspective it may become a current asset. But in this video we shall just have a very brief overview, which is usually covered in the first accounting course in the undergrad studies. So let's see that. So this is a tax collected every time the goods change ownership, means on every sale or every purchase. So long as I hold the goods, maybe for whatever amount of time, the tax will not be there. But as soon as I sell the goods, the tax will be imposed, and regardless of whether I am making a profit or not. So keep in mind, this is not income tax, right? So when I sell the goods, I will not only collect the selling price from my customer, but I will also collect an additional amount which is equal to the sales tax. So if I am selling goods worth rupees 100 or worth dollar 100, and the sales tax rate the government identifies, or the value added tax rate, right? Sales tax is also one of the value added tax. So if the VAT rate is 10%, then I will not collect just $100. I will collect $100 plus $10, 10% of $100. So I will collect $110. So we will see how do we record it. So end user bears the burden as the cost is passed on to the next buyer. As such it becomes a consumption tax. So the buyer will pay 110 and the buyer will sell it, say, for 150 to another buyer, right? So he will again charge 10%, $15. So the second buyer will have cost of 165, and so on. The tax, eventually the burden of the tax will be imposed upon the end user who is actually consuming the goods, who is not actually a business person. So that's why it's said that sales tax or value added tax is not a good tax, because the burden of this tax is equal on poor and rich. This means, in the relative terms, it's a tax on poor, because for a relatively poor consumers, this burden is high. So as a very business, every business and supply chain adds some value. So that's why we say it's a value added tax. So for example, if a producer is making some goods, then of course he is actually adding value by combining the raw material into a finished product. If wholesaler is buying, so he is adding value, which is the time value of goods, or not time value of money, or the place value, place utility, or time utility. So he is making the goods available to the retailers in smaller chunks, at the right time, at the right place. So he's also that adding that value. So that's why whenever a sale is incurred, a person buys because there is some value. He sees some value. That's why we say it's a value added tax. So the detailed accounting is very interesting. It also include accounting for the buyer and accounting for the seller, and a business who is also a buyer and also a seller. So there is an interplay of the two accounting sides. So when we buy some goods and we pay some sales tax, that's referred to as input tax, so long as we are a business, not the end user. And when we sell goods and we charge tax from customers, this is known as the output tax, right? So the detailed requirement of the input tax and output tax is not covered in this video. It will be covered in another video, because usually in the undergrad accounting courses this detail is not covered, although it's very interesting. So we will just see the accounting for the output tax. So here is an illustration. Hill Farms wheat grows wheat and sells it to Sunshine Baking for 1000 euros, and it makes the following entry to record the sale, assuming a VAT of 10%. So he will charge 1100, right? So cash will be debited by 1100, sales revenue will be credited by $1000, and value added tax payable will be credited by $100. Why we credit our payable? Because we have collected this from the customer, but eventually we have to pay it. It's not my money, that's why it's not my revenue. So we have to pay it to the government treasury. So at the end of the month, usually every month, or sometimes in some regulatory environments, maybe every week or every quarter, or maybe towards the end of the year, we pay this to the government treasury. So what should be the entry when we eventually pay this to the government treasury, right? So this is something that you should be able to do. That's we debit the value added tax payable and we credit the cash by which we pay off this. So sales tax again is also value-added tax, right? So it is again also expressed as a percentage on the selling price, and we collect it from customer and we remit it to the taxing authority in the government treasury. So here's another example. $800, 800 euros is my selling price, and 6% is the tax. So I will charge 800 plus 6%. 6% of 800 comes out to be 48. So I will collect $848 in cash, and my sales is 800, which is credit, and my sales tax payable again is 48. So just like the same, the only change is the amount and the title of account. So in the previous slide, we labeled it value-added tax. Now we label it sales tax. Same mechanism. Sales tax is also value-added tax. Another example. Now this says that we don't have the selling price, but we have the total amount which we received. So the total amount which we received was 10,600, which includes 6% sales tax. So it means this 10,600 is actually 106%. So, and out of which 100% is actually sales and 6% sales tax. So this is simple math. I assume that you people will be able to do it. So we divide 10,600. This is the total amount that we received. So it contains 100% sales plus 6% sales tax. So this means my sales are 10,000 and 600 is my sales tax. So we record this way, again the same accounting entry. And now here, from the practical perspectives, three figures are important. One is known as price exclusive sales tax or amount exclusive sales tax, right? In this case, this is $10,000. And then the sales tax, which is $6,600, and then the price inclusive sales tax or the amount inclusive sales tax, which is 10,600. So these three can be computed if any two of them are given. And also, you will note that in many regulatory environments, it is mandatory that out of these three, at least two are actually mentioned on the product. Either you mention the exclusive price and plus sales tax, or you mention the exclusive price or inclusive price, or maybe any two of them. Because if you are providing two of them, then the reader or the consumer can automatically compute the third one. So you would normally see all the consumable items, FMCG items, that there is a mention of price exclusive sales tax plus this much amount of sales tax, which becomes the price inclusive sales tax. So that's it. This is the first video. In the next video, I will record another video on this, in which we will discuss the detailed input output tax accounting related to sales tax.